Rule 11 UAA. Rule 11 UAA. Now, when is this rule applicable? Rule 11 UA, remember, is applicable for determining of fair market value of shares other than quoted shares when the transfer is at a price lower than fair market value. And I'm sure you can very easily understand that the Rule 11 UAA and Rule 11 UA2 are contrasting each other, or Section 50 CA and Section 56 to 7B are contrasting each other. So when I say contrasting each other, what does it mean? It means the 56 to 7B talks of a situation where company is issuing fresh shares but at a price which is higher than the fair market value, whereas the section 56 talks of a situation where the transfer of existing shares is happening at a price which is lower than the fair market value. And I'm sure again we can very easily understand as to what is the objective behind section 50 CA and rule 11 UAA, because if someone is disposing or transferring these shares at a price which is lower than the fair market value, obviously this will result into a situation where the resultant capital gain amount is going to be lower. And since the resultant amount of capital gain is going to be lower, the department is going to lose on the revenue that which it would have earned, or if the transfer of these shares would have been done at the fair market value. So interestingly, under section 50 CA, you have really a situation where there is a double taxation. So when I say there is a double taxation, what does it mean? It means when someone is transferring shares of a company, unquoted shares of a company, at a price which is lower than the fair market value, then the difference between the fair market value and the transfer price is taxed in the hands of the transferor and also in the hands of the transferee. Now, why it is taxed in the hands of the transferee? It is taxed in the hands of the transferee because to the extent the transfer price is lower than the fair market value, he is benefiting by that amount. So say for example, if the fair market value is 100 rupees and the transfer is being done at 50 rupees, apparently on the face of it, the transferee is getting shares worth 100 rupees, whereas he is paying only 50 rupees, and therefore he has a gain of 50 rupees, and this 50 rupees is taxed in his hands as the income from other sources. And likewise, when a share worth 100 rupees is transferred by a transferor at a price of 50 rupees, then the difference of 50 rupees again is taxed in the hands of the transferor also, and as a capital gain tax, as a capital gain. And why is that so? That is because since the fair market value is 100 rupees, he is transferring it for 50 rupees. He may do whatever he wants to do. The department is going to say that as far as we are concerned, the transfer price should have been 100 rupees. You have transferred at 50 rupees, that is your problem. We are going to tax you assuming the transfer price to be 100 rupees only. And therefore, section 50 CA is a classic example where the same amount is taxed in the hands of the transferor also and the transferee also. Now, again, please remember, the Rule 11 UA does not prescribe its own method, unlike in case of Rule 11 UA 1CB or Rule 11 UA 2, where they prescribe their own methodology for the purpose of valuation. Rule 11 UA does not prescribe any valuation methodology. What it says, it only says that if there is a transfer of shares, existing shares, of of an unlisted company or a company, then the such shares will need to be valued using the valuation methodology prescribed under Rule 11UA 1CB. And I'm sure we all understand what this methodology is. This methodology is A plus B plus C plus D minus L, and then multiply it with the number of shares to be valued divided by the total number of shares of that company. So that is with regard to the valuation of valuation in case of transfer of unquoted equity shares at a price which is supposed to be lower than the fair market value. Now, if the transfer is being done not of the equity shares, but it is being done of preference shares or other securities, the Rule 11UA 1CC come in the picture, and the Rule 11UA 1CC says that the valuation will be by a merchant banker or by an accountant, and by a merchant banker or by an accountant. So in case of 11UA 1CC, a report from the merchant banker or chartered accountant using the NAV method will be good enough. So that is your Rule 11UAA, which is applicable in case of Section 50CA, where the transfer is being done at a price lower than the fair market value of those shares. So when it is applicable number one, in case transfer of existing equity shares, and number two, fix a minimum transfer price, that is fair market value, for the purpose of capital gains tax. So you can see here, friends, so this is how you can see here is the relationship, the contrasting relationship between Section 5627B and the Section 50CA, and the Rule 11UA 1CB and the Rule 11UAA. So to sum it up, by resorting to a lower price than the fair market value, apparently there is a loss of revenue to the department as a result of lower capital gains accounted for by the seller. Interestingly, under Section 50CA, as I said, both the buyer and the seller need to pay tax on the differential amount. Buyer, because he got shares at a price lower than the fair market value, so it is treated as deemed income in his hands from other sources, and the seller has to be taxed because that is the amount of capital gain he would have earned had he transferred the shares at the so-called fair market value. So this is, friends, all about Rule 11UA, Rule 11UAA and Section 50CA of the Income Tax Act. In case if you have any question, please go ahead, else we will move to the next topic.